If you could distill most of R. N. Elliott's observations on one chart, that is the picture you would see. Anytime prices in a market are moving in the same direction as the one larger trend, they will take this path. Simply, Elliott described it as the five-wave pattern. Now, I'm going to go through this step by step just to show you exactly how psychology develops in this five-wave pattern. Then we're going to look at some real-life charts and see how well Elliott's concept is reflected in those charts. Every movement upward or downward, which is in the direction of the one larger trend, has to start from a point which is ending a previous pattern. Let's look at the bull market situation right now. Every movement of major degree starts at a bottom of a bear market. Let's assume a bear market has ended right at this point where the word bottom is. What is the development of psychology from that point? Well, from a major bottom, by which I mean a low which is going to lead to many years or even decades of price advance, usually the market will have associated with it some extremely bad news. Negative fundamental environment. If you're dealing with the stock market, you've usually got a depression or deep recession in force. There is usually an argument among market watchers about whether that market will survive, whether it will continue to exist, and that's true whether you're talking about the stock market, the sugar market, or anything else that people are trading. At intermediate lows, very often there will be the same type of negative environment, but to a lesser degree. A recession, a mild recession perhaps. Perhaps limited wars or skirmishes, whereas those major lows are often associated with major wars. The intermediate lows, something of a smaller scale. And of course then there's the short-term low. Very often you just get an overnight piece of bad news that'll correspond with a short-term bottom, and sometimes none at all. It's just the natural play of psychology giving you a short-term low in a market. From this point, wave one begins. This is going to start off the change in psychology from extreme pessimism at the bottom to extreme optimism at the top. Elliott's most important observation is that the crowd does not move from extreme pessimism to optimism in a random fashion. It doesn't get there in a straight line. It does it through a series of psychological stages. The first stage he simply labeled wave one. This is a rebound from the depressed levels at the actual bottom. It's a recognition of survival by the market, a realization that the worst has passed. Now, most participants don't necessarily understand that to be true, but the market is reflecting that by making its first wave up. Wave two, then, is a partial retracement of wave one. It's a severe test of the conditions that existed at the actual bottom. Sometimes when you look at those fundamental background events or situations, some people can actually argue that the fundamentals are worse, or at least as bad as they were at the actual price low, and yet prices hold above the prior low. This wave 1-2 pattern forms a base. This is the launching pad for wave 3. Wave 3 is usually, particularly in the stock market, the longest, strongest, and broadest move in a sequence. It's usually the longest in terms of time and price movement. It's the strongest in terms of the rate of change on the upside. And it's often the broadest, particularly relative to wave 5. And by that I mean in terms of the advanced decline figures. More stocks will be moving up relative to moving down in wave 3 than they will be in wave 5. As wave 3 progresses, psychology begins to change. You see, the average investor is 2 steps behind the market. Don't forget, this progression started with a bear market low. Most people were petrified by the end of that bear market that it was going to continue. When wave 1 occurred, a lot of market watchers said, don't believe it. This is a rally in the previous bear market. It's a trap. When wave 2 gets underway, people say, okay, the old bear market has resumed. Now, there are a lot of ways that you can verify this observation. It's not just an assertion. If you keep technical indicators of market sentiment or psychology, you'll find that at the bottom of wave 2, sentiment reflects a very powerful pessimism. Sometimes I have seen that pessimism be greater than the pessimism which occurred at the actual low. Once wave 3 begins, however, this starts to change. Early in wave 3, people are still holding on to the idea that it may merely be a rally in the previous bear market. As wave 3 progresses, there is a center point where the acceleration is the strongest. I call that the point of recognition. It's when most people in the market finally decide that the major trend is now up. There is no question about it. On those days or weeks or months, you will see extreme volume, very powerful breadth, breakout type activity. Psychology continues to change as wave 3 progresses. By this point, people are pretty optimistic about the future. You see, they've changed their minds. The major trend is no longer down, it's up. Well, by this point, they're probably, you see in the center of wave 3, they've covered all their short sales at that point of recognition. By about here, they're 50% invested. Somewhere along here, they may approach 100% invested. Right about there, they're buying options on their positions. And right here, they're buying futures contracts as well. And just after the top, if they're really bold because they're assuming this is a pullback in the uptrend, they're buying options on the futures. Well, that's why wave 4 is labeled a surprising disappointment. Wave 4 is a normal retracement. As you can see from this graph, wave 3, if it's usually the longest wave, has traveled a long way, and a correction is long overdue. A correction is exactly what the doctor ordered. The market gets it. But you see, because of the extreme optimism that was generated by this wave, the fact that people finally moved from underinvested to overinvested at the top sets them up for a disappointment, and probably even for a net loss on their positions. Once wave 4 is over, wave 5 begins. Wave 5 is the final movement in psychology toward the upside. As wave 5 begins, people regain their confidence. They say, well, we made a decision during wave 3 that the long-term trend is up, and this movement to new highs is confirming that conviction. We have no problems with this basic market. We can get invested again. We can be comfortable. Of course, wave 5 takes you into the final high, and wave 5 precedes the largest correction since the entire sequence began. Now, the 5th wave is obviously the most important one to recognize in the entire sequence, because it's going to alert you to the fact that the biggest correction, if it's a smaller degree, or bear market, if it's a larger degree, since that 5-wave sequence started, is about to occur. Fortunately, the 5th wave is the easiest wave to recognize from 2 different aspects. There's a technical aspect and a fundamental aspect. From a technical point of view, the 5th wave is virtually always weaker than the 3rd in just about every measurement. It doesn't have to be shorter than wave 3, but if you analyze the technical development of wave 5 in terms of speed of price movement, and probably most important, the participation of stocks, you will find that it is weaker than wave 3. Breadth begins to thin in wave 5. I've found this true not only in 5th waves that last a year, but in 5th waves that last a day and a half. If you compare them to the power of wave 3, you will find that the advanced decline participation is not as strong. That's probably the biggest technical key to identifying a fifth wave. Usually, particularly on smaller degrees, intermediate and lower, volume will also be less in a fifth wave. There's less power there. People got heavily invested in the third wave and they haven't got that much buying power left, and it shows up in the technical condition of a fifth wave. The second area is the fundamental area. In virtually every case, you'll find that a fifth wave has problems behind it that the third wave did not. Now, keep in mind that a fifth wave follows wave 4, and wave 4 is a correction, and usually the fundamental news background during a fourth wave is pretty bad. It's gone from the positive background that wave 3 finally generated to a weaker, scarier background that gets people out at the correction low of wave 4. So the fifth wave does show an improvement relative to the fourth wave, and that gets people very optimistic. They say, look, things are getting better. But if they stepped back and observed the chart and then said, now let's go over in our minds what the fundamental conditions were in wave 3 and compare those to what's happening today, they would have to respond that today's fundamental situation is not as strong as it was in wave 3, and that is another very strong indication that wave 5 indeed is in force.